Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm contributing editor Ron Day, and we have a great episode for you all today, this final several days of 2024. So, we're going to be talking end of the year stuff, looking into next year. And joining me today are Paul Curcio, our managing editor, research lead Ken Tooney, senior analyst Sumit Roy. So, welcome to the call. And first of all, I think just mention that over the weekend we did say goodbye to our 39th president, Jimmy Carter. He was the first future president to be born in a hospital. And the market link here is that markets will be closed January 9th. So we will have to find something to do that day, right? Anyway, so the end of the year is not exactly looking shiny and bright, right? It's not more woe than ho, ho, ho at the moment. We are expecting a Santa Claus rally. There has been no Santa Claus rally. We're getting a little bit of a dump of coal. So, Paul, let's turn to you and just some thoughts on what's going on and how investors might be feeling with this kind of grim end of the year so far.
Well, you never know how investors are feeling exactly until you see the results up on the big board. But clearly, the Santa Claus rally fizzling out is an indication of something. What exactly? Who can be sure of? We have some mixed results at the end of the year, going into the Fed decisions to decide to cut about 100 basis points over three cuts since August. And you've seen, the market rally over the course of the second half since that early August correction that we had. You've seen the Trump trade come into play, and then you've seen the big pullback. As we talked
Yes.
about recently, we had the Dow on a losing streak, the longest it's had in over 50 years.
Right.
So, what does 2025 hold for us and for ETFs? That's anybody's guess, Ron.
Yeah, yeah. Hey, Ken, what about you? What's your view on why stocks are kind of, not even pausing. They're really kind of they're lagging right now. Is it a valuation thing? Do you think, I mean, is the market that disappointed with two rate cuts next year? Were they really had they been penciling in four or maybe I think maybe it was four? What's your thought?
Correct. Yeah, it was four. And then the market was expecting kind of three, pricing that in. And then when the Fed, put out their annual dot plot that where each board member sees the rate path coming in the next 12 months, adjusted down to two. So everything that you mentioned, Ron, is playing in, I believe. I mean, Paul mentioned, Trump trade. Okay, in my view, in my simple analogy with the Christmas theme is that the Trump rally was kind of like the Grinch who stole the Santa rally. I mean,
Right.
you get a big bump after the excitement of at least a clean election. That helped things because the market likes certainty and dislikes uncertainty. So we had a clear winner, and then followed by some of the ETFs like the Bitcoin ETFs really took off. I mean, they jumped something like 30% in the week or so after the election. And then some of the ETFs that we'll talk about in a minute, the other Trump trade type ETFs, like financial sector stocks with possible deregulation or looser environment for big financials. And then small cap stocks did very well. So we'll talk about those in a minute. But yeah, I think it's a little bit of valuation investors looking at, okay, we had this big bump after the Trump election. And then what's coming in 2025? There's more concern about inflation and things like that. So it may not be just a big first year of a president's term like it often is. So we'll see.
Hey, Ken, one thing you had pointed out this morning was like volatility going through the roof today, um, which also brings up the question is how should investors I mean, is there a repositioning right now? Do you just kind of ride it out, just kind of deal with the volatility? One thing you've said to me before is that, you make money. Volatility produces, profits in investing. It could also produce losses, but just, what is kind of like the quick adjustment right now, if anything?
I think a lot of investors and advisors are looking at taking some money off the table. You look at the last 2 years, 2 years in a row of 20% plus returns. It's more like 25% plus returns. I think the total gain over the last 2 calendar years is something like 55%. I mean, that's six
Yeah.
years. That's 6 years worth of average returns in the market in 2 years. And so, especially for retired investors, maybe some more cautious investors who don't like to take a lot of risk. Maybe you've done very well and you're thinking, hey, I'm going to lock in some of those gains. And so maybe investors are being more cautious because of that. And I remember, Sumeet, then you wrote on something recently on when the stock market has 2 years in a row of 20% plus
Yeah,
returns.
yeah.
What was that? I think you can have a positive third year, but the history is mixed on that, right?
Yeah. I mean, the sample size is so small, right? It's not often you see two back-to-back years of 25% plus gains. That's just incredible. And if you look back through history, it's only happened three other times. Once it happened in the 1930s during the Great Depression, another time it happened in the 1950s, and then it happened in the 1990s during the dot-com bubble. And essentially what you find is after those two back-to-back 25% plus gains, one time the market went down the next year. That was during the Great Depression. It tanked 35% the next year. But the other two times the market actually went up. In the 1950s, it went up another 7%. And then in the dot-com bubble in 1998, in 1999, it actually went up 21%. So another monster year followed those two back-to-back 25% plus gains. So anything can happen, right? Past performance is no guarantee of future results, as they say in the financial industry. We just don't know what 2025 is going to bring us. Obviously, you can make the bull case, you can make the bear case. You could talk about AI and how that's going to power more gains in the stock market next year. You could talk about the high valuations in the market. The S&P 500 is trading at something like 22 times forward earnings, highest PE in quite a while. We'll see what happens. Obviously, we've seen huge gains over the past 2 years, like Ken said. And I think that's the reason this Santa Claus rally is kind of fizzled out. People are taking profits. The S&P 500 was up something like 29% at its high. I'm looking now, and it's up something like 25%. So it's given back a little bit of that, but I don't think we can read too much into that. The market's kind of in wait and see mode because we're going to obviously get the new Trump administration, and that's going to be potentially very impactful for the market in 2025. We just have to see what happens.
Has anybody read any outlooks from, say, like, Goldman, I guess John Hatzius, who puts out his, I guess, a highly regarded or at least well-read crystal ball? I have not really looked at anything. I don't know if anybody's been checking out any of the estimates for 2025.
I've seen some, analysts are always bullish, right? They're always expecting a 5%, a 10% gain next year. And, that's what they're expecting for 2025. We just have to wait and see. I think, like Ken said, the Trump administration, the tariffs, the tax cuts, those are going to be extremely impactful. So we have to wait and see what happens with that before we can really say
Yeah.
what it's going to do.
You also
Well,
have
the
an
expect. Go ahead,
you also
please.
have an opportunity here with the Santa Claus rally fizzling out of looking at an opportunity to reload. I mean, what do? You buy the dips, right?
Right.
And when you've had a market that's been, hyperbolic for all this time, just always going up, people forget, hey, sometimes you need to take a rest so that
Yeah.
you can get in at a good price. And keep cost averaging in. I think another thing to take a look at is you asked about outlooks. I keep seeing outlooks for Bitcoin to go to 200K. I don't know
Right.
about you guys, but that seems like a bit of a reach to me.
Mm.
What do you
Well,
think?
I noticed that some of the estimates came from people, issuers who have their own Bitcoin ETFs. So, you,
Yeah.
we want to kind of keep the source in mind. But Paul, I was talking to one of our favorite analysts the other day, Aniket Ullah, who said, okay, even though, regardless what's happening with the market at the moment, he still is expecting a bang up year for the industry we cover, which we had our first $1 trillion year in inflows. He doesn't think there's going to be another $1 trillion inflows, but he does think there's going to be 500 billion to close to another $1 trillion just in ETFs. I don't know what people are going to be buying, but that is one for our industry at least. It's people are expecting more good health. We could pivot to Kent Tooney, who knocked out an article the other day, a very well-read piece and well-written.
I can jump in there, and we already talked about some of these, but the piece I wrote was best ETFs to watch, which is just kind of, it's not saying okay these ETFs are going to outperform because no one really knows, but following up on the Trump trade idea, one potential is the Financial Select Sector Spider Fund, that's XLF. And that's going to have large financials in it, including Berkshire Hathaway, Buffett's Berkshire Hathaway, J.P. Morgan Chase. But with potential deregulation and tax cuts in the Trump administration, or the next coming Trump administration, can benefit financial institutions by lowering compliance costs, enhancing profitability, and if the banks can engage in riskier behavior, for lack of a better word, then there's greater potential for profits there. Another Trump trade we already mentioned, maybe the most obvious one to just any casual follower of financial markets is the Bitcoin ETFs. We just mentioned the high side estimates are $200,000 price, which is over double where it is now. One of those reports is from a spot Bitcoin ETF issuer, Bitwise. They said that they predicted that spot fund flows would exceed 2024. I mean, that's an amazing. I would definitely call that a high side estimate, maybe somewhat wishful, but I don't know about that. So I would put a definite caution behind that. But that's why we made it one of the top ETFs to watch, or that group. The largest one is iShares Bitcoin Trust, IBIT. Then there's small caps, the right type of soft landing environment with interest rates coming down at least a little bit, and the economy still growing. That could bode well for small caps. And then last year, we were talking about TLT and the longer duration Treasury ETFs. They were among some of the worst performers in the fixed income space in 2024, just because we had that higher for longer environment and rates not coming down like everyone thought. And so that keeps yields up high and pushes prices down. But the Treasury ETF I put in this to watch next year, or this coming year, 2025, is the iShares 0 to 3 month Treasury bond ETF, SGOV, SGOV. And that tracks 0 to 3 month US Treasuries, as the name implies there. And the idea behind that investors are interested in is you get pretty good yields, but it's low interest rate sensitivity. So if rates don't come down, or even if they stay the same or even go up a little bit, that type of ETF is something that fixed income investors would be interested in. And you can read the rest of the top 10 by going to our site. But those are some of the things we're looking at. Different sectors, possibly with Trump, crypto, and then shorter duration ETFs on the fixed income side.
Yeah. This also draws or points up the fact that, as we're talking best and worst, bond yields are ending the year near their highs. So, and we've had some, very nice performing in some bond ETFs. We have our ongoing conversation about TLT versus JEPI. And what about the best and the worst performing bond ETFs and bond yields ending the year near their highs.
Yeah, I mean, it's kind of unexpected, right? You go back a few months, Ron, what was it, September, mid-September, the Fed made its first rate cut of the cycle, 50 basis points is kind of a surprise. And since that day, the Fed has cut rates by almost, or by 100 basis points. Yet you look at the 10-year Treasury yield and it's up 100 basis points. So, I mean, I think no one expected that. The Fed cuts by 1% and the 10-year goes up by 1%. And like you said, we're ending the year close to the high on the 10-year, 4.6% or so, and on the 30-year, 4.8% or so. And I think that's kind of giving some investors pause, right? I mean, no one really expected the Fed to cut, and now rates are high. Are they going to continue to move up in 2025? Maybe because of Trump's tariffs, or maybe because his tax cuts kind of accelerate GDP growth. I mean, these are questions that investors now have to grapple with. And when it comes to fixed income ETFs, it's really important because I wrote a piece on the best performing bond ETFs of the year and the worst performing bond ETFs of the year. And I kind of just, took a look at what happened this year when it comes to fixed income ETFs. And essentially anything that's really interest rate sensitive, like TLT, did poorly. I mean, it's down something like 8% year to date. And the more, duration you put in your portfolio, the worse you did. On the other hand, Kent mentioned SGOV, which is kind of this money market like ETF. That's done well because that's not interest rate sensitive. It's not going to go down in price as yields go up. You're just going to clip those coupons, and that's returned something like 5% this year, which is much, much better than TLT. So a lot of, uncertainty as we enter 2025, I think, when it comes to fixed income. I don't know, Kent, do you have any thoughts on that?
I can add that. I mean, I would just extend just a little bit, and that's that the yield environment impacts almost everything. Of course, but like Sumit is saying, it's going to directly impact fixed income, especially the longer duration, because they're more sensitive to the interest rates, whether they're going up or down. But also the equity space, we want, or the equity space wants rates to be lower because the borrowing costs are lower, and there's more liquidity swimming around. So it's just good across the board. And even there's been correlation between what rates are doing and precious metals like gold, as well as Bitcoin. So, I mean, it's almost like everyone just wants rates to come down. And if they do, it helps everything across the board.
Absolutely. But one interesting question I have, Ken, is obviously the stock market would prefer lower rates, all else equal. But considering the fact that the 10-year is back at 5%, the stock market doesn't care all that much, right? I mean, the market's on track to end the year up over 25%. You go back a year or two ago, if someone told you, the 10-year would be sitting at 5%, yet the PE on the S&P 500 is something like 22 times, and stocks are, as expensive as they've ever been historically. I mean, I wouldn't have believed it, right? I think high rates would equal lower valuations for stocks. Yeah, we haven't really seen that. I mean, interest rates really haven't been a drag on the stock market. Maybe they have, from week to week here and there, but overall, stocks seem to be brushing off high interest rates. I mean, we'll see if that continues, if rates go over 5%, but at least for now, that's what we see, right?
Right. Yeah. I mean, you bring up another point that's almost, makes me think of, I'm only half joking here, but, we talk about, oh, we didn't get the Santa Claus rally. Everyone's, spoiled by 25% rate of return in a year. And if the market pulls back about 2 or 3%, oh, what's going on? What's wrong? But
Yeah.
you bring in a great perspective there, Sumit. Hey, things are still really way better than they normally are. So nothing's really pulled back in a major way so far.
So, Ken, what does this mean for 2025?
I mentioned a couple, like the financial sector or small cap, Bitcoin and crypto space broadly. But also some of the things I didn't touch on yet is consumers. I mean, consumer spending has been increasing at a pretty healthy clip. Even we just passed the holiday season. In general, that the numbers are slightly higher for holiday spending than it was last year. And so the consumer is not happy with inflation, but they're still spending. I saw a funny quote this morning. I forget who it was, but he said something like, it's kind of like turning 60. I mean, it's you feel the pain, but it's better than the alternative. And so that's kind of what the consumer is doing now. They're complaining about higher prices, but they're still spending. So I'll highlight a couple of ETFs. Consumer Discretionary Select Sector Spider, XLY, which is going to invest in companies like Amazon and Tesla and Home Depot, that will thrive on discretionary. And these are things that consumers don't really need. Other examples might be, luxury, travel, those types of things. I know that the airlines are doing well. Another ETF I pointed out is U.S. Global Jets ETF, JETS. Airlines are profitable, or they've been profitable. Travel demand remains robust. Increased international tourism. I mean, on an anecdotal note, I did some traveling, including up to New York and different places for work and leisure. And everywhere I go, the highways are packed, the airports are packed, the parking lots are full. So if the consumer keeps spending, then that XLY could do very well. Or if the consumer slows down just a little bit, but just keeps buying the necessities, then maybe consumer staples would do well. And that's the largest one in that area is the Select Sector Spider Fund, XLP. So that would be they're still spending on necessities like beauty, beverages, health, and all that type of thing. So we'll see. I mean, you can gather that the theme is going to be, hey, if inflation causes a slowdown in spending or the economy in general, then we're going to see lower returns and maybe some of the staples type stocks could do well. So it's still an unknown. We have to caveat that with all of this is that we just have to see how some of the Trump policies come through and how inflation does in the interest rate environment. So it's going to be an interesting year, no question.
Yeah, yeah. And in addition to, what Ken said, I'm going to be keeping a close eye on the semiconductor ETFs. Obviously, that has been a huge winning area in 2024. The AI boom has powered, stocks like NVIDIA and others, to stratospheric levels. If you look at the top performing ETF of the year, it's NVDX along with NVDL, which are the single stock NVIDIA ETFs. Those have returned almost 400% in 2024, by far the best performing ETF. So I don't know, is NVIDIA going to continue to run like this in 2025? Potentially. I mean, analysts are extremely bullish on the stock. You look at the price targets, they're much higher than the stock's currently trading at. But I don't know. It all depends on the AI boom continuing and NVIDIA's customers like Meta, Microsoft, Alphabet, they have to keep spending on the data centers and the GPUs and the things like that. So this is going to be a very important area to watch next year, especially considering NVIDIA now has, I think, a 7% weighting in the S&P 500 and ETFs tied to the S&P 500. And we all know, the Mag 7 in general are a huge weighting in SPY and other S&P 500 ETFs. I think they make up something like 1/3 of the index. And all of those stocks are riding the AI wave in some form or the other, including Tesla, which is counting on autonomous robo-taxis to power its growth in the future. And I think I'm looking on the top performers list, TSLL, the single stock Tesla ETF, up 130% this year. We'll see if that can continue in 2025, Ron.
Cool. Well, look, I think we've, I'm not going to say we have exhausted our topics, and there's always, we could talk and talk and talk, but, what we need to do is start writing some more, we'll get some more articles written so we have more stuff to talk about in the new year. Does anybody have anything else they want to toss in? Any more themes, any big stuff that we missed?
I'll just add one quick thing for say 20 seconds is to cap it all off, volatility. I mean, we just mentioned at the beginning of the call, it is up sharply today. I think with a combination of excitement on one end for the future, but also a little hesitancy about or uncertainty thrown in the mix, we could see volatility ramp up in some of those funds that track daily volatility, like the ProShares VIX short-term futures ETF, VIXI, could see a little bit more attention next year. Now, those are some risky bets, but and only for short-term investing. But I wouldn't be surprised if volatility is a theme that emerges or rises in the coming year.
All right. Thank you to our listeners for tuning in to Exchange Traded Fridays. If you haven't already, subscribe and follow us wherever you get your podcasts. If you have a question or want to share your thoughts, join the conversation with us on Twitter or send us an email, and catch you next week.